Hey, welcome back to the Presidio Perspective. Dustin TenBroeck here, CFP, President of Presidio Capital Management, with Jeff Anderson, CFA, Chief Investment Officer, in the studio. Sierra on the ones and twos, as always. Glad to be with us. Glad to have you. Let's get it going. Oh, well, thank you, Sierra. Compliments on my hat to start the show, putting me in a good mood. And hey, I can use it. What about you, Jeff?
No, we could use some good news. Yeah, definitely.
Yeah, we'd like to get some good news. Unfortunately, if we're watching the stock market, we're not getting a lot of good news here recently. So we definitely want to talk about that. Take an overview of what's going on. It's been brutal out there. And then what we're looking at, if we can look down, the road a little bit or up at the horizon, so to speak, and see, there's good news case, bad news case, and talk a little bit about that. And of course, as always, what should investors be doing, during this time, right? And what are we doing, as wealth managers for clients and helping people navigate this challenging market? And we know that these markets come, we do have these markets, and they're not fun when we're in it. And we all talk about it. We know inflation, taxes, market crashes are the big three things that we're up against. And, dealing with them is not fun, and it's very challenging, and it seems very bleak. And if anybody's been to one of my seminars in the last, 4 or 5 years, I think in 2017 I started weaving in this sobering moment of my 2-day seminar where I'd kind of look at everybody and say, hey, just take a pulse of this time right now. This is the good time, and enjoy it, because we love the good times. And sooner or later, there's that apex, and it's not going to seem like the good time. And during the good times, you're riding that roller coaster. I just took my son to Disneyland this weekend, which people were out there spending money. Okay, it was packed. And so we went on Sunday, and he's turning 11 this year. So I was like, it's my last little moment of having a kid that's joyful about Disneyland, and so I kind of wanted to take that dad moment with him. But or just you get on that roller coaster and and it's that slow build, and It's like that's what the good times are, and you're all excited, and it's going up, and oh my gosh, and you reach that apex. And then that fear just kicks in. And it's like investing is such the same way, of all this elation, getting on the ride, and oh my gosh, it's so exciting. And then, oh my gosh, that fear kicks in as soon as you just start dropping, and you start going faster, and you're going down, and you're going down. And oh my gosh, I just can't wait for it to bottom out. And sooner or later it does.
Right.
And we're just on the downside of the roller coaster right now.
Well, that's a great analogy, because they always say bull markets are like it's the escalator up and it's the elevator down, right? We've put out those charts. We put out a bunch of First Trust charts, and we show them to clients. I think they're great, and they've got that one chart that shows the bull and bear markets. The bull markets last longer. We talk about the market being upward sloping. Doesn't feel like that right now, but the bear markets are shorter, but they're just steeper, and they are they're unsettling. So we're in that time right now, and I figure, why don't we just jump in and throw out some of the things that are going on right now in the economy, and some interesting market headlines, and then we can jump into what should we be doing.
Yeah, sounds good.
So coming into work this morning, I was listening to financial news media on the way in, and I thought it was interesting. I came in, I double checked, and it was true that the Dow is, like, if we close negative this week, that'll be 8 consecutive weeks of negative returns.
Wow.
Which hasn't happened since, take a guess.
10 years, 2008.
Close. 1923.
Oh, wow. Okay.
So
this doesn't happen.
No.
This is very rare that this happens, where we don't get relief, right? And that's what we're saying. There's not that head fake relief.
Right.
I mean, we've seen markets that have gone down, faster, further, certainly. But so this has been a slower, consistent death process, is what you're saying.
It's almost like a death by 1,000 cuts.
Yeah.
So a long way from that V-shaped recovery
that
we had.
Yeah, and a lot of times you see these markets that go down and, oh, okay, maybe we're out. No, we're not. Again, another roller coaster analogy, but it's like, this one's just been kind of a steady decline, at least on the Dow.
Right.
Yeah.
And if you look at where we were at the beginning of the year, we talked about it, what changed? Interest rates started, not only were interest rates going to go higher, but the Fed was going to be more aggressive, right? Mm-hmm. And the market, the bond volatility, it's like there's volatility in stocks, there's volatility in the bond market and the government bond market. And that volatility is at all-time highs because the big smart bond traders are trying to figure out what that terminal rate is. And what's that terminal rate? Well, it's where the Fed says we're going to end. When we're going to raise up until some number, we're going to take out all the excesses, we're going to get things back to normal, and just like us, we tell people that it's an uncertain world when we invest, right? There is no certainty, but we clamor for certainty. Well, so do the institutional managers. They want some kind of, okay, how am I going to trade my book? I need to know what that terminal rate is, and that's started to settle down. And in the meantime, what's happened? We've had the go growth stocks had the big hits, and I just read something last week that one of the big hedge funds out there, Melvin Capital, which was all-star. He worked at SAC Capital, Stephen Cohen, which is, I think, what Billions is based on, right? Yeah. And he was a high-flying, young, brash portfolio manager, and he was caught on the wrong side being short all these meme stocks.
Yeah, taken out by Wall Street.
Suffered all these losses. Yeah. Stephen Cohen and other partners had to come in and bail him out, and then he ended up shutting it down.
Yeah.
And he's down 20-something%
in
April.
But we've gone past that. So it's you could say it's the go growth stocks.
So that was the first to go, right? And he's just the tail end of what happened there.
Right.
But some of the bigger names held up really well for a while, and then all of a sudden Apple started to underperform. And we talked about like Berkshire Hathaway, Buffett coming in there and buying as it got cheaper. He's not worried about a recession. He's looking at what is Apple worth in 10, 20 years from now. If the Mr. Market wants to be in a bad mood and he wants to offer me great bargains, I'm going to buy them. He's not trying to pick bottoms or pick tops.
Well, what's happened with Apple?
Apple's, I think, lost about $500 billion in market value.
Right.
Which is a lot. Well, where does that money go? Some of it's sitting on the sidelines, and some of it's rotated out of tech, communication services, and then where have they gone? They've gone in defensive names. Well, defensive names have gotten really expensive, and what's happened in the last couple of weeks?
Well, a lot of that money's just gone. I mean, it's not like it went somewhere, right? I mean, it's what people are willing to pay. And so, when the price adjusts, a lot of times it's not like, I mean, it's money getting taken out.
It's money getting taken out, but it's going somewhere else. Right. And we agree to disagree, maybe.
Okay.
Because that money is,
well, so let's say my home is worth $1 million, okay? And so, hey, I got, I have $1 million, and let's say I have no mortgage, and it's just for simplicity's sake, that's my value. And then, housing starts going down, and like somebody is only offering to pay me $800,000.
Right.
So that's where it's like that money's kind of gone, right? I mean, it's not like it was paper money, and a lot of times we see that paper money evaporate, when we go through these bear markets, and people are counting their balance sheets and their net worth and how much things are. It's because, well, the prices got inflated of what somebody was willing to pay for that.
Right.
And then now they're not willing to pay that price.
But that's one single asset with one purchase price and one sale price.
Yeah.
There's 1 trillion sale prices on the way down.
Yeah.
So people are exchanging. I'm buying, you're selling.
Mm-hmm.
And so I'm taking that cash and I'm putting it somewhere else. And so the point I was trying to make was we talk about sector rotation. So people have been walking away from tech.
Mm-hmm.
And we've got big, venerable tech companies trading at very modest multiples to history and even to the market. And yet the defensive names that don't grow nearly as much, aren't nearly as profitable, but are stable, are trading at higher multiples than they are, and are trading at elevated multiples just intrinsically to where they've traded historically. So there's been this big rotation, but a lot of I've even read articles where a lot of tech managers are saying that their tech portfolio that's growth but earning companies like the Googles of the world are cheaper than Coke, What do you want to own? It's not to disparage any one company, but you're having this crazy dislocation. So you're having this rotation. And when we talk about consumer sentiment.
Well, you like to quote Buffett a lot, and I know what his answer is there.
Yeah, well. So
he owns a lot of Coca-Cola.
He does.
Drinks a lot of it too, Diet Coke. But
yeah.
Okay, so that's your point, is that there's a lot of selling going on in other parts of the market that are bringing their prices down, and there's not as much selling going on in some of those other names, and potentially some more buying in some of those names that are more defensive or kind of.
But the defensive names, I think one of my points is that they're not exactly cheap,
yeah,
because everybody's rushed out, because these companies got so large that when you take out $500 billion and put it somewhere else, it's going to move markets.
Yeah.
Right. So, and then we talked about, interest rates, what's going on. We know that the Fed's going to continue to raise interest rates. We talked about that, 50 basis points, probably getting 2 more of those. And they're talking about getting the overnight rate up to 3%. And yet, with all that, the 10-year has been on a tear. We know that. The 10-year government bond was at 1.5, and it was at 70 basis points during COVID. And it crossed 3%, and everybody said the 40-year bull market is over.
Yeah, we kind of knew that was happening.
It would happen. But what are bonds doing? What were they doing in the beginning of the year versus now? Bonds were not acting as a ballast. They were going down just like stocks were going down, because they move inversely to interest rates.
Right.
And over the last month, they're starting to actually act like a ballast to the portfolio. They're not really going down. In fact, they're kind of starting to move up slightly. Right. So there's some normalcy returning.
Yeah.
And then talk about consumer sentiment.
So let's pause on that for a second, because that's really good for balanced portfolios and asset allocation. And so we did have a dislocation in January, right, when we were kind of adjusting to that. But I mean, that's how the portfolio diversification, asset allocation typically works over long periods of time. And so, even if bond prices are stable, and you're earning 3%, that really helps a lot to bring that fresh cash in the portfolio, whether it's for your own spending needs or to rebalance into equities at depressed prices.
Right.
And it's like, and so that's the normalcy that we're talking about. And the ballast would be like, hey, stocks are going down, so maybe your fixed income goes up a little bit, and we see that happen definitely during, severe sell-offs, which gives you, again, the opportunity just to not be down as much, right? Because you have some ballast, and so your overall portfolio is having some things work and some things don't, which gives you a rebalancing opportunity to sell my bonds high and buy the stocks low, right? And so we're seeing that happen, which is nice. So it gives a smoother ride for investors, as we go through this bear market, gets them confidence that they have enough of that fixed income and cash to be able to meet their income liabilities, the money that they need to take out of their portfolio, to buy them a long-term time horizon on their stocks to say, okay, I'm not going to panic. Right. So that's really important to see that back in the portfolio.
Right. And that period that we had for the first 3 months, 3.5 months, where both bonds and stocks were going down is not normal. Mm-hmm. And over the long term, they'll restore that relationship. And we've just witnessed it over the recent future. So I think that's good news.
Yeah.
And again, with higher interest rates, you're going to get higher yields. Like you said, you're going to start to earn some cash on your savings.
Yeah, I think that's really important. And so, you talk about a bond bull market, but I mean, it's really they play off of each other. And you say, where are you going to put the money, and you're in equities that are sliding down, and you're worried about recession. I mean, there's a demand, a flight to safety that happens where people want to own bonds. And I think that's really important, that demand is there, especially if they're paying that income.
Right.
As they're attractive, right, at some point, especially if the Fed gets inflation under control and you're earning a real return on your fixed income. That creates the demand, which should continue to stabilize as the Fed unwinds its balance sheet.
Right. So ultimately, it's painful now, but it's healthy long term.
Yeah. So
that's something to be cognizant of.
I mean, in the painful now, I mean, this is really. I mean, I know we have a lot of data points here that. Well, go ahead. Comment about what happened with Target and Walmart, because that was kind of the big news. You had Ross Stores report today, and they had a really big disappointment. And so, what's going on there in the retail sector? Because you talked about big tech and and small tech, big tech,
right.
Fake tech, whatever it was. And then now it's kind of permeated and even defensive. And then now, consumer staples and retail. So what's going on there?
A couple things. What's interesting, just take Target and Walmart, the two largest retailers in this country, Walmart being significantly larger, but both reported earnings, and I think Walmart was the first time they'd really surprised to the downside in decades.
Yeah.
And part of it was both of them ramped up inventory, right? They had a better, with their scale, able to get inventory better than the smaller retailers, but it ended up they had the wrong inventory. So, meaning some of the consumer discretionary items that they bought, like lawn furniture, people weren't buying it. They were buying essentials, and they were buying generic brands, not the name brands.
Name brands.
And on top of that, the Target CEO came out and said, "Well, our sales are $106 billion. We're going to spend another $1 billion extra in fuel, just moving stuff around."
Yeah.
Getting it off the ships into the distribution centers, getting into the stores, and doing the online delivery. It's $1 billion. Is it going to be $1 billion every year of extra? No, but right now it was just something that nobody was prepared for. And Target, the first quarter, they said, we're going to keep market share. We're not going to raise prices. And all of a sudden, they got the wrong inventory mix, and fuel prices are up, and it's longer than they thought. The Russia-Ukraine conflict lasts longer. Energy prices are elevated, and it's percolating right through to the economy.
Yeah.
So, but that's, in my opinion, that's short-term stuff. I mean, they move their inventory. At some point, they'll discount it. They'll move that stuff. They'll get the right inventory. They've got the best data. Prices for fuel will get baked in, but it also feeds into, you have this climate right now where people are worried. And before it was like, looking for good news, and now we're just looking for bad news, any bad news. And so we like to kind of shoot the messenger. That's the environment we're in right now. We talked about it just before the show, consumer sentiment. What levels did we see right now? I think they're approaching, if not below or at 2009 levels. Yeah. So we are hitting some pessimistic levels.
Yeah. I mean, you have this consumer sentiment U.S. index going back to, what is this, 1955 or something like that?
Yeah.
And I mean, we're approaching all-time lows. I mean, when I look at this, and let's get this up so everybody can see the U.S. index of consumer sentiment. But I mean, we're right there in 08, 09, 2011, which is a time we commented on previously, right? Where we were looking at consumer sentiment, and 81, 91. I mean, you look at these things, and I get kind of excited to see that.
Well, it is a leading indicator. So when it plummets, it usually plummets before the market, but then it gets to these lows, and that's usually, counter-cyclical, if that's the term. But that's, like you said, it's usually a positive. You get too negative, the pendulum's usually going to swing back to normal.
Mm-hmm. Yeah. Yeah, and you have a nice correlation here with the S&P 500 on consumer sentiment, and so that's what you're talking about. So
right.
Consumer sentiment dives. We don't have a crystal ball, but everybody is watching this market as saying, is the bleeding done? Is the cutting done?
Right.
Are we finding that bottom, and to where maybe we can stabilize or potentially go up? We talk about a V, a W, a U. Kind of what type of recovery we get after this. It's been a relatively short time of a bear market, and markets going down. So we got about 6 months of this, but it's kind of like, okay, is enough, or things getting bad enough, and we're all waiting for that and looking for that moment.
Right. And one other point about bottoms, a lot of people like to ask that question. I get that question a lot. They're like, are we at a bottom? Like, well, nobody knows. You're only going to know a bottom when it's in the rearview mirror. Mm-hmm. Until that happens, you're not going to know. But you've got the S&P trading at 17 times earnings right now. We talked about in September about potentially what could happen when the Fed reverses course.
Yeah.
But over a 10, 15-year time horizon, I mean, you can't get too cute, but you have to realize that those are the kind of things that can happen. So you say the good times, the great times, well, they're defined because there are bad times. If there weren't bad times, there'd be no such thing as good times. So you're going to have pockets of bad times, and we're in it right now. And you pull up the paper, and anytime you want to read it, there's something negative. Gas prices now, I call it the Hotel California. The rest of the country is starting to feel what we've felt forever.
Yeah.
Now we're above 6, and somebody said we might get to 8, 6.5. I saw the other day, 6.69 or something for premium. But the national average is almost 4.50. That's a big number. Like the places like Texas and Florida used to rely on $2.50, $3 gas, and now $4.50. So everybody's kind of feeling it, and at some point that will abate.
All right, let's just duke it out here, because we were having a conversation over here this morning, right, about high prices curing high prices. And, I think that when I look at that, it's like, well, that hasn't happened yet. And you're saying it will, right? I think that high prices curing high prices mean the gas can only go so high because, eventually people are going to stop driving. Or the food can only be so expensive because people will stop buying it. Like, that's hard to give up, right? So then you're like, okay, well, people are going to have to go and shop and buy food. They're going to buy not the name brands. They're going to buy the essentials, right, as we're seeing them do that. Maybe they're going to – but then what starts happening is they don't buy the car. They don't take the trip. But that hasn't even happened. I'm telling you, I'm at the theme parks. It's packed.
Right.
People are buying. I mean, the people are traveling. People are still buying automobiles.
Right.
And you're like, how are people spending through this? Well, that's causing inflation. People are still buying real estate at ridiculous prices.
Right.
It's starting to occur where that's going to start to go down. But this is because when we look at this market and this bottom and like what's on the other side and going through all the short-term pain, it has been and will likely remain that this is so much focused on what the Fed is going to do. And that's what Wall Street's looking for. That's what they always have been. So, they were enjoying the allowance, and now they're sad that we don't get it, but we're kind of wondering when the Fed is going to become accommodative again and stop the tightening. And that's just eyes on inflation. And they're pretty much dead set about just making that happen, right? And so that's the worry of like, oh, is there a lot more pain that we're going to endure? Because they have to get that inflation. And so what's going to make people stop spending money? Well, how about if they see their 401k turn into a 201k, as people said in 08 all the time? How about if they see their real estate values go down by 20%? People will stop spending if that happens.
Yeah.
And they saw their cryptocurrency evaporate.
Right.
Right? And their rent, is probably going to continue to increase a little bit. Like you mentioned, it's usually a lagging indicator, or it lags real estate prices. Real estate prices have gone up. So it seems like the Fed is pretty committed to bringing the asset prices down. I mean, what's your take on that?
Well, that's exactly what they're trying to do, and they're trying to do it navigate a soft landing. That's what you hear about. Mm-hmm. You read it, you hear about it, and the people, the non-believers in Powell and his group, believe that it's impossible. If you want to bring down inflation, you're going to cause a recession. It's going to be a nasty one. Others saying they think they can navigate a soft landing, and we won't know. But
I mean, what are the odds that we are in a recession right now? I mean, we got the first quarter, didn't we?
Yeah.
So, I mean, we might be, in a recession. I think there's probably a good chance that that's the case.
We could be.
And if you want to talk about bottoms, that's typically, I mean, you go through the stages of a market.
Right.
What are they?
Well, you're talking about the business cycle or just the market?
Yeah, the stages of the market.
The early, mid.
Yeah.
So you've got the early cycle, the mid, the late, and the recession.
Yeah.
So the early cycle, when you're coming out, you're expanding, corporate earnings are growing, inflation is not around, interest rates are low, corporate profits are high, sentiment is not quite, it's not bearish, but it's not quite bullish. And then the mid cycle, you start to see kind of a moderating monetary policy. Corporate earnings are still growing. Psychology is getting better. Corporate profits are still growing. And then when you get into that late cycle, then you got interest rates are starting to go up. Why? Because inflation's starting to increase. Why is inflation increasing? Because the market is overheating. The economy is overheating. Corporate profits start to slow. Psychology is still high but turning. And then towards the end of it, you end up with the opposite happening, which is interest rates finally get control of inflation. They slow everything down, and markets don't do well in that environment, and then usually what ends up happening is small cap companies usually underperform coming into the recession, and so they kind of start to diverge. They start to move lower faster and sooner than the large cap. And some of the consumer discretionary, the credit card companies, the auto companies, because the economy is slowing. And when we talk about being in a recession, I don't think some people said they saw Q1 coming. I don't know. But even if we had 2 quarters of negative GDP, that would be enough to be technically a recession.
Yep.
And small caps have underperformed. Some of the cyclical companies like the GMs of the world were trading at $65. 5 months ago, they're trading at $38. You've got companies like credit card companies trading at peak earnings or trading at 5 times earnings. It sounds really cheap, but that's the peak earnings of the cycle. And they're starting to underperform. So this is just all a cycle. Then you get into that recession, and then at that point, nobody wants to own anything, and that's the best time to own it.
Yeah.
But it's hard to do it.
Yeah.
So we'll find out where we are, but pessimism is certainly has prevailed. Optimism is out the window over the short term.
Yeah.
But what's great about situations like this is that when the markets go down, they become cheaper. And think about if you're in your accumulation stage and you're doing your 401k contribution and you're putting money into your IRAs outside of that, do you want a market that's going up every single?
No.
You want it going sideways or down because every month you're buying it cheaper or some lower price.
Absolutely.
You want it at the top of a bull market when you're entering retirement. You can shuffle your asset allocation around. So there's always good things that come out of this.
Yeah.
It just doesn't feel like it right now.
Yeah, your dollar cost averaging, you're buying more shares per dollar of savings.
Yeah.
And that's a huge win, right, when this starts happening.
Right.
And you know, just comment about those 4 cycles, you know, and you look at the time that we're typically in them, right? And I think that's an important thing of how long they last. And the expanding and stabilizing, you know, early to mid or much longer, you know.
Yes.
And then you kind of get to this bearish sentiment, and it is, again, just like that roller coaster. I mean, it's a slow build up, and we're enjoying it, and it comes down really fast. And so that late stage, you're like, are we in it? Boom, we're out by the time we can call it a late stage. And then you're like, are we in a recession? Yeah, we have been. We're probably on our way out, right? Because it's backward looking, and it kind of happens. But sometimes those asset prices, they drop, and it's just too good of an opportunity.
Right.
You know, and so, you know, typically we find that bottom. And if you look back at past recessions and, you've shown that bull versus bear kind of timeline of like bull and bear markets and how long we're in a bull market versus in a bear market. And so that's just kind of what we see. And we're looking back at history, you know that typically when things are just at their worst, that's when Mr. Market really starts to change its tune. And so, you know, for those investors that are getting skittish and like, oh, I need to stop the bleeding, I need to get out, it's like the worst thing you can do. I think most people know that. We've been battle tested over the last couple of years with these 20-35% drops in 2018 and 2020. And every time we say, but this is different. But no. Now we don't have an accommodative Fed. Well, what about the global pandemic, where we shut down the economy? What about a trade war with China? What about a financial housing collapse? What about a tech wreck? I mean,
we've survived them all.
We do. And so if you're long term, put your eyes on the horizon, not on the stock market dial, and hire people like us to take care of this for you. We're in there getting ulcers and doing the hard work for everybody. But look, you do the work in day one, right? And so what opportunities are there for investors today? So during these bad times, if you're accumulating, just try to keep saving, keep your savings rate. And if you can save more, this is where a lot of wealth is created. Things are worth less today than they were 6 months ago. You can go buy those same companies, great companies over the long run at a discount, right? Your stocks and socks analogy, right? We always look for sales except for when we're investing. Like things are on sale, okay? And just get your time horizon. If you are a long-term investor, just stay that course and keep going. If you are not adding and you're subtracting from your portfolio, this is why you have asset allocation. This is why you have fixed income in your portfolio. This is why you have more stable investments. And, so it's a good time to just make sure that, I'm not going to panic, right? Because I have the right asset allocation. I'm long-term. This stuff's down. It's probably going to go up and down a lot of times before I ever sell it.
Right.
Right. And that's how you create a lot of wealth over the stock. I mean, if you look at the last 10-year, return on the S&P, it's still what, 12, 13% annualized return, even where we are today.
Yeah.
Yeah. We've gone through some ups and downs along the way. Right. But a lot of wealth is being created if you can just stomach those ups and downs.
So what are the other two things I think what are the two things we talked about that we can do in market corrections? We talked about Roth conversions and
tax planning. Absolutely. So, if you have a non-retirement account, you're going to be likely having some opportunities called tax loss harvesting, where, you can sell those investments that are down, buy something else that's very similar,
yep.
Right? Recognize that loss. And if you're down 20%, and you recognize that loss, multiply that by your tax rate, like, oh, that's a 7% gain, that I can use that tax loss to offset other gains, offset ordinary income. And that actually is a money maker.
Yep.
Right? And then your position is something very similar, that on the recovery, you still get that recovery, but I got to earn that tax loss. So that recovery is all tax-free, or to the extent that I was able to recognize the loss.
Or it can be used against gains down the road. Yep.
Right.
Great.
So that's real money in your pocket that you can use during these markets.
Right.
Right. And so, again, that's something that we do for clients.
What about the qual accounts?
And then the qualified accounts, where a lot of people have their investor money. I think people know this who've, know Presidio, is that this is Roth conversion time, and this is a part of a plan, especially if you're before this required minimum distribution phase. But, okay, here we are. And, if I was going to, if you think of your IRA or your 401k, the reality is about 65% of that is your money. Roughly. Depends on what state you live in and what your income tax bracket. But let's just say 2/3 of that money is yours. 1/3 of that money is the government. So whereas a Roth IRA or a Roth 401k, it's all your money. 100% of it is your money. So right now, if the market's down and you're down 20%, I just throw that number out there. That's not indicative of anything. But if it's down 20, you're only down 14, right? Because 6 or 7% of that is really the government's money that's down. Does that make sense?
Yep.
So what we do is we push it out at a lower price. I mean, would you want to pay taxes at 100 or 80? Great, I'm going to push it out at 80.
Right.
So I'm going to pay less tax for those same amount of shares to go into a Roth. And if it just gets back to even, what a big win, because I paid a discount on the tax I owed the government, and now 100% of that recovery is all mine. Right?
Right.
I mean, this is just math.
Right.
And when it comes to tax planning, it's pretty black and white. So when things are down, this is the time to pay taxes if we can, right? Rebalancing portfolios to create losses, repositioning, and certainly people with concentrated stock positions, take a new look and see what you can do, because there's probably some tax loss harvesting to help rebalance that position.
Yeah, great point.
And then getting those specific assets that you have, the ones that are even down more, pushing those out to a Roth, and where you get the recovery. Keep your whole asset allocation intact, but just push those more depressed ones out in the Roth that have the best chance for the recovery.
Right.
So, tax planning during bear markets is super important. Most important is not panicking and not cashing out and not, saying, oh, no, I can't take this. Right? Yes, you can. We have the plan. You can do it. Make sure your asset allocation's in line. But not panicking, asset allocation, tax planning. It's what we do during these times, right? And they will be temporary. Markets go down temporarily. They go up permanently, right? It's a famous quote from somebody famous.
And don't bet on the end of the world.
And we don't bet on the end of the world. And, when we're down, it just never seems like we're going to get up again. But we do. So hang in there. Don't do anything silly, Jeff. I am looking forward to a future podcast with great news about what's going. But during these tough times, we're always here for you at Presidio. If you ever want to speak with us or have any questions about what's going on in the market, Jeff and I are here to answer. So hope you follow us and subscribe to our YouTube channel, and stay tuned for more news this summer at the Presidio's Perspective. All right, guys, have a good weekend.
Take care.